What if you could walk away from the daily grind tomorrow and still afford the life you've always dreamed of? Without any vague guesses or mystical formulas, just one clear number that tells you exactly when freedom is within reach.
Imagine the sunrise over a quiet beach, the hum of a home office that you no longer need, and a world map waiting for your next adventure, all because you finally cracked the code to financial independence.
I'm a longtime advocate of the FIRE movement, and I've spent years helping people untangle the math behind early retirement so they can make confident,
bold decisions about their future.
In the next few minutes, I'll walk you through the exact steps to calculate your personal magic number, show you how that number fits into a realistic timeline,
and hand you a simple worksheet you can start using right now.
First, let's define FIRE in a single sentence. Financial independence. Retire early means building enough assets that the income they generate covers all of your living expenses,
allowing you to choose how you spend your time instead of being forced to work for money.
The magic number is simply the total amount of money you need invested so that a modest, sustainable withdrawal can fund your lifestyle forever. The cornerstone of this calculation is the 4% rule, a guideline that suggests you can safely withdraw 4% of your portfolio each year, adjusting for inflation, without depleting the principal over a typical retirement horizon. To reverse engineer that, you multiply your annual expenses by 25, because 1 divided by 4% equals 25.
That product is your magic number, the sum you need to have sitting in your investment accounts before you can consider yourself financially independent.
Why 25? Think of it as the inverse of the 4% safe withdrawal rate. If you need $30,000 a year to live comfortably, you multiply 30,000 by 25 and you arrive at $750,000. That figure represents the capital that, when you take out 4% each year, will give you exactly the 30,000 you need, while the remaining 96% continues to grow and keep pace with inflation. Now, let's add a little nuance. The 4% rule was originally designed for a diversified portfolio of stocks and bonds in a tax-advantaged account. If a large portion of your assets sits in a taxable brokerage, you'll need to account for capital gains taxes on your withdrawals, which can push your required magic number a bit higher. Likewise, if you have a mix of tax-free retirement accounts, the effective withdrawal rate could be slightly lower, allowing you to aim for a smaller target. Market volatility also matters. Some experts suggest a 3.5% rule for more conservative investors, which would increase the multiplier to roughly 28.6. For now, we'll stick with the classic 4% rule because it provides a clear, widely accepted baseline. Let's walk through a quick example. Meet Alex, a single professional who spends $30,000 a year on housing, food, travel, and hobbies. Using the 4% rule, Alex multiplies 30,000 by 25 and lands at $750,000 as the magic number. If Alex currently has $150,000 saved, the gap is $600,000.
That gap tells Alex exactly how much more needs to be accumulated before the dream of quitting the 9-to-5 becomes a reality.
Now that you understand the target, the next step is gathering the personal data you'll need to plug into the formula. Start by listing every recurring expense you have: rent or mortgage, utilities, groceries, transportation, entertainment, and any discretionary spending you regularly enjoy. Don't forget annual costs like vacations, car maintenance, and holiday gifts. Break those down into monthly equivalents so everything lines up. Once you have a clear picture of your total monthly outflow, multiply by 12 to get your annual expenses. This number is the foundation of your magic number calculation. Next, assess your current assets. Include the balances of all retirement accounts, brokerage accounts, high-interest savings, and any other investments that can be liquidated without severe penalties. Exclude the equity in your primary residence unless you plan to downsize or sell, because that value isn't readily accessible for daily spending. Also, note any debts, student loans, credit card balances, mortgages, because they affect your net worth and the amount you truly need to replace with investment income. Finally, consider your expected rate of return and inflation. A common assumption for a balanced portfolio is a 7% average return before taxes, with inflation hovering around 2%. Using these figures, you can estimate how many years it will take to bridge the gap between your current assets and the magic number, assuming you continue to save a portion of your income each month. A simple spreadsheet can model this by applying compound interest to your savings and subtracting the projected withdrawals once you hit the target.
If this is blowing your mind, hit subscribe and let's keep exploring together.
Now, picture yourself with a clear spreadsheet in front of you. On the left, a list of every expense broken down to the monthly level. In the middle, a tally of all your investable assets. On the right, a projection of how many years of consistent saving will get you to that magic number.
As you fill in each cell, the abstract concept of financial independence transforms into a concrete, achievable plan. You'll see exactly where you stand today, how far you need to go, and which levers you can pull, whether it's increasing your savings rate, boosting investment returns,
or trimming discretionary spending to accelerate the journey.
Think about the power of having that number in your hands. No more vague hopes or endless scrolling through forums trying to guess when you'll be free.
Instead, you have a roadmap that tells you, if you keep saving $200 a month and your portfolio grows at an average rate of 7%,
you'll reach your magic number in 25 years. Or, if you can boost your monthly savings to $500, you'll shave 5 years off that timeline.
The clarity alone can be a catalyst for taking decisive action. What do you think?
Let me know in the comments. I really want to hear your perspective on calculating your own magic number and the steps you're planning to take next. Now that we've sparked that curiosity, let's dive deeper into the practical side of turning that magic number from a vague idea into a concrete spreadsheet you can actually use.
I'm going to walk you through each column, each formula, and each assumption so that you can replicate the model on your own computer, or even on a piece of paper if you prefer the analog feel. First, open a fresh spreadsheet and label the first column Year. This will be your timeline, starting with the current year and extending forward until you hit your target. In the second column, call it Starting Balance. This is the total amount you have invested right now, before any growth or contributions for that year. If you have multiple accounts, say a tax-free retirement account, a taxable brokerage, and maybe a small side business fund, add them together to get a single figure. Don't forget to include any cash you keep in a high-yield savings account, because that counts toward your portfolio as well. Next, move to the third column, Annual Contribution. Here you'll input how much you plan to add to your investments each year. If you receive a paycheck every 2 weeks, you can calculate your monthly savings and then multiply by 12, but be sure to keep the number in words when you type it into the sheet. For example, if you intend to save $300 a month, that translates to $3,600 a year. Write it out as 3,600, not as a digit. This column is where you can experiment with different savings rates. Maybe you want to test a scenario where you increase your contributions after a raise, or where you cut back on discretionary spending and redirect that money into investments. The fourth column is Growth Rate. This is the assumed annual return on your portfolio before taxes. A common baseline for a balanced mix of stocks and bonds is 7%, but you can adjust this up or down depending on your risk tolerance. If you're more aggressive, you might model a 9% return. If you're more conservative, perhaps 5%. Write the percentage in words, such as 7%, and use the spreadsheet's built-in percentage function to apply it to the starting balance plus contributions.
Now, the fifth column, Ending Balance, is where the magic happens. The formula adds the starting balance, the annual contribution, and the growth earned on the combined amount.
In spreadsheet terms, you'd take the starting balance, add the contribution, then multiply the sum by 1 plus the growth rate expressed as a decimal. Remember, the spreadsheet will handle the math for you, but you need to make sure the growth rate is entered correctly. 7% becomes 0.07 in the formula, even though you write it out as 7% in the cell label. After you have the ending balance, you'll want a sixth column called Withdrawal. This is where the 4% rule comes into play. Once you reach your magic number, you'll start withdrawing a fixed percentage of your portfolio each year to cover your living expenses. The rule suggests 4% of the ending balance, adjusted for inflation each year. To keep things simple in the early years, you can set the withdrawal to 0 until the ending balance meets or exceeds your magic number. Once you cross that threshold, calculate 4% of the ending balance and place that amount in the withdrawal column. The seventh column, inflation-adjusted expenses, tracks how much you need to spend each year after accounting for rising prices. If you currently spend $30,000 a year, you'll want to increase that figure by the inflation rate each subsequent year. A typical long-term inflation assumption is 2%, but you can adjust it based on your expectations. Write the inflation rate in words, such as 2%, and use the spreadsheet to multiply the previous year's expense by 1 plus the inflation rate. Finally, add a column for net cash flow. This is simply the withdrawal amount minus the inflation-adjusted expenses. In the early years, before you start withdrawing, this column will be negative, reflecting the fact that you're still saving.
Once you begin withdrawals, you'll see the net cash flow move towards 0, indicating that your portfolio is covering your cost of living without depleting the principal.
With all these columns in place, you can scroll down the timeline and watch as the ending balance grows year after year.
When the ending balance finally surpasses your magic number, you'll see the withdrawal column light up and the net cash flow will start to balance out.
That moment is the point at which you can confidently say you've achieved financial independence. Let's bring this to life with two concrete examples. The first example is a single professional. Let's call her Maya. Maya is 29 years old, works in tech, and currently earns $80,000 a year before taxes. She lives modestly, spending $25,000 a year on rent, food, transportation, and entertainment. Maya has already saved $120,000 in a mix of a tax-free retirement account and a taxable brokerage. She decides to save 15% of her gross income each month, which works out to $1,200 a month, or $14,400 a year. Maya assumes a 7% return on her investments and a 2% inflation rate. Using the spreadsheet we just built, Maya inputs her starting balance of $120,000, her annual contribution of $14,400, and a growth rate of 7%. She runs the model year by year. By the time she reaches the age of 54, her ending balance climbs to $899,000, just shy of the magic number she needs to sustain her $25,000 annual lifestyle. At that point,
the model shows that if she bumps her savings rate up to 20%, meaning she saves $1,600 a month, she can shave off roughly 5 years, reaching her magic number at 49.
Maya can see exactly how a modest increase in her savings rate dramatically accelerates her path to independence. The second example is a married couple with 2 children. Let's call them Carlos and Elena. They are both in their mid-30s, earn a combined pre-tax income of $150,000, and have a household expense of $55,000 a year after accounting for mortgage, childcare, groceries, and transportation. Their current investment portfolio totals $350,000, split between a tax-free retirement account, a taxable brokerage, and a small rental property that generates positive cash flow. Carlos and Elena decide to allocate 20% of their combined income to savings, which translates to $30,000 a year.
They also plan to increase their contributions by 5% each year as their salaries grow.
They assume a balanced portfolio return of 6%, a slightly lower figure because they have a portion of their assets in real estate, and they use a 2% inflation assumption. When they plug these numbers into the spreadsheet, the model shows that they will reach a portfolio value of $2 million, roughly the magic number needed to fund their $55,000 annual expenses by the time they are 59.
However, if they decide to accelerate their savings by taking on a freelance side gig that adds an extra $10,000 a year, the model projects that they can achieve the same target at 54, giving them a 5-year head start on early retirement.
These two scenarios illustrate how the same basic framework can be customized for different life stages, income levels, and family structures. The key takeaway is that the magic number is not a static, one-size-fits-all figure. It's a dynamic target that shifts as your expenses, savings rate, and investment returns evolve. By regularly updating your spreadsheet with actual numbers, actual contributions, actual returns, and actual expenses, you keep your plan grounded in reality rather than speculation. Now, let's talk about a few common pitfalls and how to avoid them. One frequent mistake is ignoring the impact of taxes on withdrawals. If a portion of your portfolio sits in a taxable account, the 4% rule may need to be adjusted upward to account for capital gains taxes and dividend taxes. A practical way to handle this is to separate your portfolio into tax-free and taxable buckets. For the tax-free bucket, you can safely withdraw the full 4%. For the taxable bucket, you might aim for a 3% withdrawal rate, or you could factor in an estimated tax drag of 1%. Effectively withdrawing 3% after taxes. This nuance can be reflected in the spreadsheet by adding a column for tax-adjusted withdrawal that reduces the gross withdrawal amount by the expected tax rate. Another pitfall is underestimating market volatility. The 4% rule is based on historical data from a specific period, and while it has held up well for many retirees, it is not a guarantee. To test the robustness of your plan, you can run a Monte Carlo simulation, which randomly draws returns from a historical distribution and projects thousands of possible outcomes. Many online tools allow you to input your savings rate, expected return, and time horizon, and they will generate a probability of success. If the probability falls below, say, 80%, you might consider either increasing your savings rate, lowering your target expenses, or extending your retirement horizon. A third consideration is the sequence of returns risk, which is especially relevant in the early years of retirement. If the market experiences a downturn just as you begin withdrawing, your portfolio can be eroded more quickly than the average model predicts. One strategy to mitigate this risk is to keep a cash reserve, perhaps 1 year's worth of expenses in a low-risk, liquid account.
This buffer allows you to avoid selling investments at a loss during a market dip.
You can incorporate this reserve into your spreadsheet by adding a cash buffer column that tracks the balance of your emergency fund and reduces withdrawals from the investment portfolio accordingly. Let's also discuss the role of asset allocation. A common recommendation for someone in the accumulation phase is to hold a higher proportion of equities, perhaps 80% stocks and 20% bonds, to maximize growth. As you approach your magic number, you might gradually shift toward a more conservative mix, such as 60% stocks and 40% bonds, to reduce volatility. This glide path can be modeled in the spreadsheet by adjusting the growth rate each year based on the assumed asset mix. For example, a portfolio with 80% equities might be assigned a 10% expected return, while a 60-40 mix might be assigned a 7% return. By visualizing how the ending balance changes with different allocations, you can make an informed decision about when to rebalance. Now that you have a solid framework, let's talk about how to keep the momentum going after you've built your spreadsheet. The first habit is to review your numbers at least once a quarter. Update your actual contributions, actual portfolio balances, and any changes in your expenses.
If you receive a bonus, a raise, or a windfall, plug those numbers in and see how they accelerate your timeline.
If you experience a market correction, note the impact on your ending balance and adjust your expectations if needed. This regular check-in turns the spreadsheet from a one-time exercise into a living financial dashboard. Second, consider automating as much of the process as possible. Many brokerage platforms allow you to set up automatic contributions from your checking account, and some even let you schedule recurring transfers to a specific investment fund. By automating, you remove the temptation to skip a month and ensure that your savings rate stays on track.
You can also set up alerts for when your portfolio reaches certain milestones, such as 90% of your magic number, which can serve as a psychological boost.
Third, think about diversifying your income streams. While the spreadsheet assumes a steady contribution from your primary job, adding side hustles, freelance work,
or passive income sources can dramatically increase your savings rate without requiring a lifestyle upgrade.
For instance, renting out a spare room on a short-term platform can generate an extra $1,000 a month, which, when added to your investment contributions,
can shave off several years from your path to independence.